So buying a put is basic. Buying a call is basic. Selling a call, selling a put is basic. Doing a vertical put spread or a vertical call spread is basic. Doing an iron condor, that's selling a put spread and a call spread simultaneously. That's basic. Selling a strangle, that's selling a naked call and a naked put simultaneously. That's a basic strategy. You want to know those basic strategies because once again, everything else is just deviations from those basic strategies. In this video, we're going to go over the three pillars of the basis of options. Now, you've probably seen a number of different videos on YouTube about the basis of options. So what's going to make this video different? What's going to help you understand the basis of options a little clearer? We believe that if you understand the three different pillars of the basis of options, then it will translate into understanding options at a more comprehensive level just by going over the three pillars, right? Because they all kind of connect and kind of build this foundation that you need to be successful at trading options. If you are having a problem with your consistency of making money, with your kind of understanding of options as you've been trading it for the last 6 months, year, 2 years, 3 years, 5 years, if you're still having a problem, then it's probably something to do with your foundation, that you started options poorly. You built your options kind of knowledge on a poor foundation. So let's talk about the three pillars, and let's start with pillar number one. The first pillar is understanding what is a call and a put and what's happening when you buy that call and the put. So for time purposes in this video, we're not going to go over all the details, but I'm going to kind of give you that roadmap that you need to be able to understand these three pillars. So for example, if you're looking at the screen here, you see that we have this image. We have an image on the left, which is the buying a call and a put, and we have the image on the right part of the image is selling the call and the put. So if you are a buyer of a call, then you're what is considered bullish. You want it to go up. If you are the buyer of a put, then you're bearish. You want it to go down. And so what you want to understand by this is that if you are a buyer of options, you're like the buyer of car insurance. You're going to an insurance company like Geico and you're buying insurance. Monies are coming out of your purse, coming out of your wallet to be able to pay for their insurance. Okay? So if you're the buyer of a call, you're bullish. If you're the buyer of the put, you're bearish. Monies are coming out of your account. You're paying for a policy. You're paying for insurance, basically. This is how I want you to understand this analogy. Now, if you are looking at the right-hand side of this image, then this is where you become the seller. And the seller is acting like the insurance company. You become the insurance company. You become Geico. Right? You become a one-woman or one-man insurance company operating in the open market because you now are the seller of policies. You are selling a contract to whoever's buying the option from you. So if you are the seller of a call, then you are what is considered bearish. Monies are coming into your account instantaneously that you never have to give back. You never have to give it back. It comes into your account instantaneously. You are bearish and you want that underlining to go down. If you're the seller of the call, you're acting like the insurance company. It's the opposite of buying the call. It's the opposite of buying the call. When you're the buyer of the call, monies are coming out of your account and you're bullish. When you're the seller of the call, monies are coming into your account and you are bearish. Okay, so you can be bullish or bearish using just the call. You just have to understand what's happening. Are you buying it? Then you're bullish. Are you selling it? Then you're bearish. Then if we jump over here to the put side, when you sell a put, you are bullish. You want it to go up. Monies are coming into your account instantaneously and you never have to give it back, just like when we were talking about the call. Now, if you are the seller of a put, you're positive on the underline and you want it to go up. And you want it to go up. It's the opposite of buying a put, as you can see on this image here, that if you're the buyer of a put, you're bearish, you want it to go down, monies are coming out of your account, and you can either be bullish or bearish using a put only, just like you could using a call only. If you're using the put, if you are selling the put, you are bullish, you want it to go up. If you're buying the put, you're bearish, you want it to go down. And so this is really hard for most to understand, that you have to understand what's happening when you're buying and selling calls and puts. And it seems simple when you're looking at this image, but it's hard, and it's hard for all people to understand initially. So we tell people just to memorize the process initially. I hate memorization, but you want to memorize this until you get it down, and eventually you won't have to memorize it. You'll know it in your head. It'll be second nature for you. But you have to understand this first pillar. What's happening when you're buying and selling calls and puts? If you do not get this, then you're building a poor foundation from the start. Okay? So let's move on, and let's now talk about the second pillar, and that's understanding the option chain. So I'm going to bring up an option chain here on the trade platform. So we recommend TastyTrade. It's a phenomenal platform. The founders of TastyTrade, well, the founders of Thinkorswim, they know what they're doing. This platform is awesome. So we recommend this platform the most. Now, looking at this option chain, when you're looking at option chain, you have dates. You have dates to the left, and these are just the date of expiration. You have what is called weekly options. That's going to be designated by a W. You have quarterly options. That's going to be a Q. And if you don't have a weekly or quarterly, it's most likely a monthly option that expires on the third Friday of that month. That's the main expiration, the third Friday of that month. You look down this middle area here, these are the days of expiration. So if you look here, you got October the 20th, 2023, that's 46 days from now. So we're going to look at this 46 days to expiration. And then when you open up an option chain, it looks like this. Calls are to the left and puts are to the right. Okay? And when you're looking at an option chain down the middle of this vertical area, these are the standardized strikes that are set up by the exchanges like the New York Stock Exchange or the NASDAQ Stock Exchange. They're standardized because you can see them wherever you're at in the world. Now, when you're looking at an option chain, going up on your screen is actually going down. So you got the 451, the 450, the 449, and so forth. This is actually going down on an option chain, and then going up is going down on your screen. So you got the 452, the 453, 454, and so forth. This is actually going up. And so this is pretty brilliant how they set this up. It's going to be confusing initially, but as you get to understand it and trade more, you're going to consider it brilliant as well. Now, back to this here. Once again, you got calls to the left and you got puts to the right. This orange horizontal line is going across the TastyTrade platform. It's what is called the at the money line. We call it the ATM. And that's just where the stock is currently trading at. So the SPY last traded at around 451.21, and that's just basically in this area here. This is the at the money area. Above the at the money area on the call side is what is considered the in the money area, the ITM. Below it is the out of the money area, the OTM, and then on the put side, it's the opposite. This is the OTM area, the out of the money, and then this is the in the money area on the put side. So it's super important that you understand the at the money, the in the money, and out of the money, because this is how you determine your obligations and your rights. Do you have an obligation to sell shares to someone? Do you have an obligation to buy shares from someone? Do you have a right? Do you have a right to buy? Do you have a right to sell? And then probabilities. What are your probabilities? Do you have a 50-50 shot? Do you have a 99% chance of winning? You can actually set up a probability of 99% chance of winning on all your trades depending on how you set that option up. So we're not going to go over that in this video, but just understand you want to know what's happening on the option chain because of rights, obligations, and probabilities for the most part. Okay? Now, this is the second pillar. Let's move on and let's talk about the third pillar. Now, the third pillar is understanding basic option strategies, because if you understand the basic option strategies, you'll be able to understand all the different exotic things that people come up with out there because it's just deviations from the basic strategies. You have to understand the basis of the basic option strategies. If you do not, then you're going to have a poor foundation because you're not going to understand what type of trades you are putting on, what strategic type of trades you are putting on. Do you have a trade that is going to make money irrespective if you are right directionally? You can set these type of trades up. You do, when you're setting up a trade that's a directional play, do you think you have a higher than a 50-50 shot? If you do think that, then you might be misleading yourself, especially if you are buying the options. If you're buying to be bearish, if you're buying to be bullish, the best probability you can have is 50-50, and you want to know that. And you're only going to know that if you understand the basics of option strategies. Understand the basics of our strategy. So buying a put is basic. Buying a call is basic. Selling a call, selling a put is basic. Doing a vertical put spread or a vertical call spread is basic. Doing an iron condor, that's selling a put spread and a call spread simultaneously. That's basic. Selling a strangle, that's selling a naked call and a naked put simultaneously. That's a basic strategy. You want to know those basic strategies because once again, everything else is just deviations from those basic strategies. Right? So you want to be an expert at the three pillars. Once again, the first pillar is understanding what is the call and the put and what's happening when you're buying and selling the call and the put. The second pillar is understanding the options chain, where you're at on the options chain, what's your rights, what's your obligations on the options chain, what's your probabilities. You want to understand that at a super high level. And number three, you want to understand the basic option strategies. You have to understand the basic option strategies. Now, if you found value in this video, we encourage you to consider subscribing to our channel. Support us that way. Help us. We're trying to grow the 5,000 subscribers, so we need your help. If you haven't subscribed to us yet, please do. Please like the video if you found value, and we hope to see you in the next video. Bye for now.